All right, recording the session. So yeah, Mike, tell us what's going on with the feds. They raised it another 0.75.
Yeah, they raised another 75 basis points, 0.75%. Not a direct correlation to mortgage rates. The when they announced the hike, mortgage rates actually got better at the time until Jerome Powell started speaking, and he basically talked about, the gist was that we've kind of lost the wrangle on inflation here, and we might have to overcook the rate hikes to curb this thing, which basically is implying they don't know how high inflation is going to go or when it's going to get under control. Inflation right now, for everybody that's on this call or anybody that watches this later, mortgage rates are being crushed by inflation, not by what the feds are doing. Okay. The last time that the Fed's fund rate was in this target area, you're talking about low 5%, high 4% interest rates. Right now, they're in the mid, pushing high 7s. And that's because of inflation. Inflation devalues mortgage bonds, so a higher rate of return is needed. And that is what is causing the issues. So
Why is that? Like in basic economic terms?
So $1 today is worth more than $1 tomorrow, because inflation devalues your dollar today. So if you're borrowing something on a long-term scale, and inflation is 7 or 8%, and you're borrowing at 4 or 5%, someone's losing there. Someone's dollar is devaluing faster than the rate of return that they're getting. So the yields need to go up, rates need to go up to compensate for it, and that's what's causing the issues with mortgage rates being where they are. Remember,
So
who likes talking to our
all this to just how will they know when they've done damage enough to slow inflation?
Yeah, I mean their favorite indicator is CPI. There's a few things that go into it. Jobs, jobs reports. The non-farm payrolls were not fantastic today, so that's actually helping mortgage rates. But CPI is the number one thing the Fed looks at, and that should start to get better. That's a rolling 12-month number. So the inflation has been going up because September's reading of this year replaced September readings of last year. September's reading this year was consistent with the months prior, 8%, 9%, somewhere in there, or 0.8, 0.9, which annualizes to 8 or 9%. But it replaced a 0.3 from last September. So the CPI index goes up, inflation goes up at that point in time.
Okay.
Now, as those months come in, they're starting to roll off high numbers. And so that should bring inflation somewhat under control. It's wildly complicated. Monetary policy isn't like the thing that's kind of scary from an interest rate perspective is that they don't seem to be able to rein this in with monetary policy right now. And what happened in Europe a couple of weeks ago, the UK, where basically they stopped mortgage lending for a brief period of time because there was no buyers for the bonds. And then the government had to come in and start buying them again. Well, that's an inflationary action. That's caused that when the government has to step in like that generates inflation. So that was the first indication that monetary policy can't get this thing under control. So it's interesting to see how it's going to shake out. The high rates that we're seeing now, how high will they go? That's anybody's guess. If you go on Facebook or Reddit, there's people telling you that we're going to see 9%, 10, 12%. I mean, it depends on what inflation does. I don't think without seeing inflation readings over 10, that doesn't historically constitute rates over 10, but they've been below the inflation readings to try to, they're thinking it's like a roller coaster. You go up to the top of the roller coaster and you start to come down. Well, they think that they've been coming down month over month, and they haven't been, and that's why they continue to stay high. And plain and simple, the Fed messed this up from day one. And anybody that followed when they were saying that this stuff was word they were using was transitory. It was just factually incorrect, and there was no evidence at the time that it was. A lot of money got pumped into the system, and it's going to take a hard time to kind of weed that out and see where it goes. So it's, what I would, if I'm an agent, I think you've got to think more, stop projecting it, and what can you do now? You know what I mean? What's the environment you're in? But buyers' numbers are still good. There's still an appetite. You're still. I had the same conversation and a similar thing with our Arizona market. Completely different marketplace. Okay, a lot of second homes, right? A lot of vacation properties.
They're probably seeing a bigger decline in prices already, right?
Huge pumping of the brakes. I want to be careful with decline in prices. Decline in asking price, sure. Homes aren't appreciating at the rate that they were, but no one there has lost money on a property yet. No one that is selling a home is selling it for a loss there today. That's kind of a concept that gets misconstrued to the consumer. Like, this isn't 2007, 2008 where home values are tanking and people are underwater on them.
Right.
Could someone
some areas are seeing that? I know my friends in Vegas are seeing price declines pretty quickly.
Yeah.
But again, each market is completely separate from another market.
Yeah.
Everything I'm seeing in this area is it's a decline in sales volume, but prices definitely has not been affected yet.
And we don't track under contract. We don't track like the offers coming in. We've been pretty well, I mean, we do track it, but what I'm looking at in this marketplace is I'm looking at new prequels coming in. Okay. And that has slowed dramatically from where it's been the last 2 years, but it's pretty consistent with where it was in 2018, 2019. All right. Okay. So I think if you're a real estate agent, the first thing that I would do is stop talking about the market declining or deteriorating and change the verbiage to the market is normalizing. Okay. Right. It is going to come down. Those numbers were elevated. The appetite for those homes with artificially low interest rates was elevated. It was a crazy market, right? But what you're seeing now is a normalization of the marketplace. We're getting back to 2018. We're getting back to 2019. And who here remembers everybody thought the housing market was going to crash in 2018 and 2019, that it was overcooked, and wait to buy, wait for the recession, wait for the pricing correction. Homes are now up 23% from where they were there. So, right. This is a supply demand issue. Interest rates are going to absolutely cool the demand, but we're still seeing a strong demand, and everybody thought it couldn't keep going at the rate it was in 2018, 2019. Well, gasoline was poured on that, and now we've seen rates swing back the other way, and consumers still have the appetite for it in this area because there are good jobs, there are good schools, people will pay for those things,
Right. So, when we talk about demand, right? So we talk about so there's just people that are going to figure this shit out on their own, right? There's people that are just like, I'm making good money. I want to live in a nice house. I can afford it. I don't give a shit. So you have that group of people that's just going to automatically go around and do things. When I look at markets like this, there's always comes up ways that you can, people have said no to themselves without even having a conversation with someone that's experienced about it, whether it be an agent or a lender. And they're just like self-sabotaging their own goals because their friends say it's ridiculous to buy right now because the rates are 7%. So like one of the reasons I wanted to, just jump on this, short notice and talk about this is just to try to figure out some of the creative options or creative hooks that we can use. I know talking with a team that's in Vegas that's I was on a webinar the other day, and they are seeing a little bit more drastic of a hit there. And sellers are trying to figure out like, how much am I going to have to reduce the price to get this house sold? So it's a little bit more extreme there right now. However, some of the strategies they're using from a listing perspective, which they're also trying to like revive people based on a buying perspective too, is just to use a hook like, hey, who would be interested in buying a house right now if you could get a 4% interest rate?
Mhm.
And obviously that's, they're accomplishing that through a buy down. So they're doing a 3-2-1 buy down and explaining,
Mhm.
obviously, once they get that conversation started, what that looks like. It's 4% first year, 5%. This was based on a few days ago. I don't know if it's going to be different in a few days, but it's, 4% first year, 5% second year, 6% third year. And hopefully by then you have a chance to refinance.
Yeah.
Do you
Yeah.
see that being a viable strategy here?
Buy downs are a fantastic strategy, and it's you, again, market specific. So in our region, you're probably going to see 2-1 buy downs versus 3-2-1 buy downs.
Okay.
And the reason being is our property values are way higher than they are out there. So that 3% for that first year, that's probably gonna cost almost a 2% concession here alone. And
Okay.
then you're gonna talk about a 2% concession for so you're talking about a 4% concession to make something like that work. Some lending programs cap at 3, that's a good chunk of money. So 2-1 buy downs we see here a lot. And we're using that on a client right now. It's the listing was like 550, right? And the payment was $300 or $400 a month more than really where they wanted to be to make it work. So we ended up working with the agent to structure the offer. It was taking about $11,000 buy down. Okay.
To do a 2-1?
To do a 2-1 buy down.
Okay.
And so it was saving her 600 something bucks a month in year 1, and it was saving her almost 400 in year 2. 3 was like 380 something. I might have the calculator here somewhere.
Okay.
But the home was also, this was also Boston, where they have primary residence exemption. It wasn't on primary residence exemption at the moment. It's going to take about a year for that to kick in. And so once that does, it's going to, regardless of what her 2-1 buy down payment is, it's going to be back in that price range that she was looking for. So the home was on market just long enough that, like, I think it went 1 weekend, and then just before we got to the next weekend, I presented this to them.
Yeah.
They offered 565, so 5K over asking, but with a 12K concession.
Yeah.
So they basically split it.
Yeah.
They basically split the difference. Got under contract. Buyer's thrilled.
Right.
She's gonna have the buy down rate. Even if she runs out the buyout and goes to her normal payment, it's she doesn't have the opportunity to refinance in the next 2 years. She's gonna be where she wanted her budgeting to be anyway. And so that's where, like, I'm kind of saying, like, start being mindful about your conversations. Start being mindful of I like your know exactly what to say. Start talking about a market normalizing. Okay. And then that leads you into, listen, as the market normalizes, interest rates are going to normalize. All right. So let's use a buy down. Okay. Because when the interest rates normalize, the pricing is going to come back up, because the appetite's going to come back up. So you get the house at today's price. We make it affordable. You're at the O shift thing. I was adamant, and I've seen Joe Herrera pick up on it and run with it. This crisis is affordability. It's
Right.
not housing values. It's not like it was in 2007, 2008. And anything that you're seeing in prices coming down, it's because the appreciation was so rapid and so artificially generated by low interest rates. It was going to happen. But very few people are losing money in this marketplace. There's going to be some, that maybe went in the summer of this year, just as rates were starting to go up, and they'll lose a year of appreciation, but they're not going to take a bath to the tune of the way things were, years ago. And largely they're at a rate below market if they were buying this summer, and it'll stabilize and normalize, and that value comes back up. Like,
Right.
the the
I mean,
one
you
thing
need
that they
highly
really,
motivated sellers and a lot of inventory and an increasing supply for anyone to get nervous enough to say, shit, we got to drop our price $50,000.
yeah,
And I just don't see it in Massachusetts. It's not like a bunch of people are saying, we're out of Massachusetts, we're leaving, we're not coming back. The baby boomer population typically decide, as a whole, at one point they were all moving to Florida or
mhm,
south. Now it's like you see, like they don't want to leave their families for
yeah.
a full year.
That
So
moving to that moving to Florida thing really jammed up a lot of the marketplace. Like that was what everybody assumed was going to happen. They were going to move to Florida,
yep,
sell their primary residence here. That didn't happen. What ended up happening is they bought a place in Florida and kept their place here.
yeah,
Like,
yeah.
you know, it it's caused a lot of that logjam.
And there's not enough new construction. There's not going to be a ton of foreclosures. So nothing is going to change the inventory supply. So it's not going to greatly affect the prices. But you're totally right. It's an affordability issue. If gas prices were under $2 a gallon right now, and grocery prices and food prices and consumables was not so high, nobody would be barking at the 7% interest rate.
Yeah, yeah. And again, even in this marketplace, people still kind of aren't, there's been a checking, there's been this pausing. We're having to have more traditional conversations with our borrowers.
Yeah,
It's really been a normalization of the marketplace. And
right.
that's what people just are so short-sighted about, is that it's just a matter of things getting to where they should be, which even then still had a huge, huge, huge supply issue. And that's still going to be there. So rates had to go up. Didn't expect them to go this high, this fast. But I guess if you think about it, they lowered the rate to 0 overnight in COVID. I remember I missed 1,000 calls from people thinking that they were getting 0% mortgages when that news happened.
Yeah.
So why not pump it back up just as quickly? And it's
Well, that just goes to show you too. It's the way information is put out there can affect the general mass opinion of things. Like they thought they're going to get 0% on their mortgage.
yep,
Now the opinion is it's just the general opinion becomes it's not a good time to buy because the rates are just ridiculous compared to
yeah,
6 months ago. And all their friends that got in at 3% are probably telling their friends, I don't know why the hell you would ever buy right now. We got in at 3%. You're going to buy a house at 7%, and then they laugh at their friends. It's unfortunate, but that's what the human nature is, to follow the crowd. Like, oh, we shouldn't be buying right now because the crowd is saying don't buy because the interest rates are terrible. So this is where it's like, we have to get them to conversations with us. We have to get them to conversations with you
right,
to really break down their personal situation and say, no matter what, in your scenario, you're paying $3,000 a month in rent.
yep,
Why hold off buying your first property?
yep,
It doesn't make sense, but somehow we need to get those conversations. That's the hardest part right now, which is why I talk about creative marketing to at least get that conversation started.
yeah,
Where, you might put out there like, hey, if I was able to get you a 4% rate, would you be thinking about buying right now?
yeah,
It's a much deeper conversation. We all know that, and we're not lying. There is an opportunity to do a 3-2-1 buy down, but it's probably more likely, like you say, a 2-1 buy down is probably more likely. But those are conversations you have in a deeper sense, not putting out there like to the world. You need that conversation starter.
yeah. You're absolutely right. Right now the marketplace is commanding deeper conversations and more of a dialogue, and you do have to tailor your hooks to get that conversation. It's funny how, like, somewhere along the way people just forgot basic behavioral economics. Like, people buy high-end Mercedes cars, right, as a status thing because other people can't do it, right? It's like, and that's kind of what home ownership has become with these lower rates. People are now like, oh, it's a high rates. Like, you don't want to go buy a house, because owning a home right now is kind of like owning that Mercedes. And it's like, And people just think that this advice goes out as you know, everybody's got everybody's own best interest in mind. No, people are generally selfish people, like, and they want what others can't have. And it's like, you know, I had one client 2 weeks ago that was looking to make an offer. DTI was in like, debt to income was in like the low 20%, you know, and the older sister of one of the it was a husband wife, the older sister was just like telling them there's no reason to buy, no reason to buy, like never buy, blah 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 blah, like hang on to it. And she's got this just gorgeous house that she bought at the right time, and is like belittling her sister for not have bought buying back then, you know. And it's like, yo, stop with this advice from her. Let's look at the economics of the situation at hand for your situation. Is this a long-term buy? They had a second baby, they were in a condo, right? They needed more space, they wanted more space, they weren't going anywhere for a long time. The rent was maybe a couple $100 less than the proposed mortgage would be. I was like, there's not one single economic indicator that says don't buy this house, other than your sister's kind of putting you underfoot here. Like, this doesn't make any sense. So stop listening to the hindsight professor, and think about things that are in front of you, and look at the hand you're dealt and play it and see if it makes sense that way, you know.
Right.
If
What
anybody knew what the future would bring, they'd be far wealthier. And
Yeah, right. Right. I just shared on my Facebook feed this morning. Like, I remember I was selling out a 6-unit single family style condos in Westford, and they were modular construction. And every agent that came was like, "You're out of your minds trying to get 300,000 for these." This was 9 years ago.
yep,
And
yep,
one was just sold like last year for $450,000.
crazy.
You know, like it's just like, you know, it's like everybody's got an opinion. I think the hardest part about this whole thing in the last 3 months is probably how fast the rates up. I was curious to like know if there was any other market in the last 30 years where they've increased that fast.
No, simply put, no.
No.
That delta hasn't been, I mean, savings and loan crisis in the 80s, maybe, but that's hard data to go back
Yeah.
and mine, because it wasn't kind of tracked in the right manners. But this fast, this furious, no, it really is unprecedented.
Yeah. So that is a hard thing for people to stomach. You know, if they know anything about where real estate, they know where the rates were, even if they weren't in the market to buy. So it's probably keeping more people on the sidelines that aren't having conversations with us, because it seems so drastic. You know,
Yep.
in and of itself, it creates, I think, an image of the sky is falling.
Mm-hmm.
You
Yeah.
know, so it's like if you could get to the conversation level of people to say, you know, okay, let's take a deep breath. Do you have a good job? Do you feel secure in your job? You're paying $2,500 a month rent. You could have a mortgage that's equal on a first-time single family or condo, especially in Worcester area. Like, and just take a deep breath and say, okay, you know, can you deal with this? You know what I mean? And like, that's
Mm-hmm.
you're not gonna, most people, I'd say 95% of all people aren't going to be able to come to those terms by themselves without talking to a lender, talking to a real estate agent. They're just
Yeah,
not.
I agree.
You know, it's almost like in the financial advisor world, like most people just don't go out there and invest a lot of money in stocks alone. They're looking for a financial advisor. You know, and I
Yeah.
don't think there's been any other time where people needed a lending advisor and a real estate advisor as much as they do now.
Yeah, it's, you know, from our end, you know, it's, people tend to focus on the financial planning, right? But the anybody that knows, you know, finance, or knows a little bit about corporate finance, knows that half of the equation is debt structure. Okay. And this is the single largest debt structure purchase of someone's life. And they're trusting the information to people that are not equipped for the conversation. They're getting their information off of, you know, just like they got their poli-sci degrees during election season, and then everybody had their PhD during COVID. now all of a sudden everybody's an economics professor about inflation. Like,
Right.
it just doesn't make sense to me that a proven inefficient place to get your information is where everybody still continues to go to get their information. And I think that, as I said on that O Shift panel when we were talking about it, if someone comes and asks me, is this the right time for me to buy? It is always the same answer from me. Maybe I need more information. I need more
Yeah.
variables.
I've
And
said it to agents too, to try and get people from no to maybe first. I can't, like, you're right. You can't underestimate that enough. Like,
Mhm.
if you're just screaming the world, it's a great time to buy and you should buy, you should buy, you should buy, it's going to get you nowhere.
Yeah,
You have to say, I don't know. That every person, like, there are a lot of the markets we've been in. It's like, it's like you can make broad statements like that. It's a great time to
Mhm.
sell, great time to buy, rates are great. Like, this is a totally different, this is an individual market. It's like, what does your situation look like? It's completely
Yep.
individual. And that's what's
Yep.
different in this market than a lot of markets. It's a completely individual decision.
Yeah.
So the more we can focus on maybe, hey, I want to have a conversation with you. It may be the right time for you. It may be not.
Yeah.
What else? I mean, what else are you guys? What do you think are other avenues for just opening up conversations with people?
I think so. I think this is kind of in two halves. I think if you're an established agent with a book of business, okay, with a database, I think you have a massive, massive advantage because there's a great opportunity in there. Okay. If I'm, Mike with Real Broker Lux Group, the first thing I'm doing is I'm going back in the last 36 months and I'm looking for anybody that I pre-qualified that I sent a house listing to and that I had a meaningful conversation about buying, and I'm compiling that database and I'm calling through that and I'm seeing who ended up buying, and this is an activity that agents hate doing because it's like FOMO, fear of missing out. Like they almost would rather not find out that someone closed on a house with someone else,
Right.
right? Than find two or three transactions in there. And it's mind-boggling to me. I kind of understand it because I'm in a similar position, and it does bug me when someone goes and finances elsewhere when I did all of the work and went through it. But
Right.
you
Or you
know,
missed a step and missed a follow up, and you're like, damn, I just cost myself
yeah.
money.
But how much value in there, Tracy? You've done this a long time. Is in there knowing what that step was missed, right? If you're blowing money out the tailpipe and it's a simple hole to patch,
Right.
like you've got to look back and you've got to look at the failures to figure it out.
Well,
So first off,
that's probably where most agents have failed, including myself, honestly, of really working and having like a really tight database that you're really working like
mhm,
legitimately consistently. I think most of us we just had bandwidth problems. We were so busy that the bandwidth just said, well, I don't even need to think about my database because people are just constantly calling me wanting to do something in real estate. And now we're
yeah,
all like, crap, I wish I was working my database for the last 3 years. And now it's it's a place where you're like, oh, I haven't called these people in a long time. They're gonna be like, where the hell have you been? And it's just something like I tell agents all the time, you got to find find reasons to call them that don't, that are just like, hey, I know we haven't chatted in a while. It's been kind of crazy the last few years, but just curious, did you ever end up buying a house? Whatever it may be, just you got to do it. You just got to
yeah.
do it.
The second thing I'm doing, if I'm some form of an established agent, or especially if I'm a broker like you, Tracy, is I'm going through and I'm looking at any home that's been on the market, you know, call it 2 weekends. So anything that's been on there essentially 18 to 45 days. All
Yeah,
right. And I'm looking at any conversation that I had with a prospective buyer that was even close,
yeah,
like even close. And I'm getting a good lender involved, and I'm saying, hey, did your client calling those offers back or those conversations back? Like, before I do a price reduction, is your client remotely interested in this house? Because I think if we do a price reduction, we're gonna have a few people. Can we work something out ahead of time? And then let's talk and see if a buy down or something makes sense.
Yeah.
to bridge that gap, because I can help sell these properties for you. Like, that was the point that we were making in that shift thing, is like, you don't totally know how a 2-1 buy down works. You don't totally know the pros and cons of it, and it's not really in your wheelhouse to learn the ins and outs of it. So let's talk about it and see if it makes sense. Let's get a conversation going and see if it makes sense. Adjustable rate mortgages, that seems to be the thing that people are also focusing on and trying to dig into. And those are, you know, there's an argument for those as well. The problem with adjustable rate mortgages is that the lenders that offer them are very hard to perform in a purchase market. Okay, they're usually smaller banks and credit unions, and sellers hate seeing those pre-qual letters come over, and it's a difficult product to close on. It's a bank risk tolerance product. The capital can run out on those programs. You can get someone under contract and then find out that the price, and they change the pricing willy-nilly. They could say you're locked in. I mean, we've seen all of these complaints in the last 3 weeks. I was locked in at this rate on an ARM, and now they're telling me that it's going up. Okay, I'm not going to call out the banks by name, but big banks that you all have people working with right now are having these issues, and then they come back at closing. Oh, well, we need this condition. Oh, this income calculation was done wrong. Like, that's usually means that they're running out of funding and they're trying to kill transactions that are tricky. That happens with big bank ARM lenders all the time. Okay. It's a really hard product to have on a purchase transaction from a confidence standpoint.
Right.
Two, ARMs are inherently risky because you can have this nice low rate and it sounds good, fixed for 5 years or fixed for 7 years or something. But when you're going to refinance these ARMs as rates comes down, people tend to not want to go up even 0.25% to fix in the rate at some point in time, right? So say you're at 4.75 on an ARM and I can get you out of it 12 months from now for 5%. The temptation is to, well, no, I'm at 4.7. I want to ride this out. I want to see how low they can go, whatever. And those are an index tied to a margin, right? So you could see the margins in the Fed funds rates and things start to come down, and the regular mortgage rates start to come down, and your adjustments on ARMs can still be going way, way up. It's just there's not a correlation. That teaser intro does not have to be your margin plus index, right? So the indices can continue to go up. The margin stays the same, but if you were at this artificially low number in the beginning, it makes it hard to get out of, and they're a major affordability issue. And then if something catastrophic happens, a job loss or something that makes it hard to get out of later, there's obviously going to be a cap on an ARM, but it's usually way higher than what the market rates are today. So they're a tough product. The ARMs make sense if you
problems with those in the past too. I mean, that's
exactly. I mean, kind of a hard correlation just because that was such a odd period of time from a loan quality standpoint.
True.
But like, the ARMs make sense if you plan to be out of the home in that period of time. Like, if you're going to sell it in 5, you're going to sell it in 7, because then it doesn't matter. But the buy downs, you can accomplish a lot of that and have a really nice built-in protection should things continue to go haywire, which, I think insurance is probably the number one thing you can have.
Right. And if you're feeling like it's borderline, where you're on that fence with affordability, we would all hope, and again, we don't have a crystal ball, but we would hope that inflation, I mean, their goal is to, slow inflation, that some of the other affordabilities like consumables and gas and everything else out there, that starts to soften a little bit. So as that rate goes up 1%, so, the second year, that, you're not feeling the impact as much as you would right now. So I do like that. I do like that program. What are you seeing in the jumbo loan market?
So jumbo loan markets,
where does that start in Middlesex County?
So in Middlesex County here, we can use the 2020. Let's pull up the numbers.
And the reason I ask this is, like, I looked at the numbers the other day when I was doing my market report, And in some cases, I think it's worth an agent focusing on a little higher price bracket than they probably did in the past, only because the biggest significant drop in sales volume has been under 500,000.
Yeah, now,
So in Worcester County, it was 27% lower sales volume this year versus last year to date. So the sales volume has dropped tremendously, which makes sense. It's who's going to be affected most by inflation and affordability. It's the first time home buyers. It's it's the average family. But there was a much
well,
less decrease in sales volume for everything above 500,000.
and don't forget too, we should probably look at the data on this. How much stuff with a 30% appreciation over the last 2 years, how much stuff got priced up into the 500s? Like your
Right.
your stock of homes in that price point are nearly non-existent.
Right.
It's where do you have to go to get up?
You're looking to do deals like for, in the next year, you're either focusing all your attention in an area that's going to be limited on inventory and where buyers' affordability is going to be on the fence for many families. It's, maybe it makes sense to be focusing on a little different market. If you can, sell a $700,000 house, it's equal to two $350,000 houses. Maybe it makes sense for some agents to kind of up their category more or less. You're probably in many cases a little less affected as a family if you can afford a $700,000 house.
Yeah. Yep. We had one transaction in, I think this was Arizona. There was a 2-1 buy down. The concession was going to cost 2.25 on that particular one. And we got together, me, the buyer's agent, me, the listing agent, and the sellers themselves. And we did hey, let's sell this thing together. I gave a 0.5% lender credit. The real estate agent gave 0.5% the commission, and the seller ate 1%.
Okay.
Right. The $700,000 house, realtor made 1.5 versus 2.
Okay.
Again,
Yeah, absolutely.
all day.
Okay.
Seller only took half the hit on the thing, and everybody went on with their day. So again, it's facilitating these conversations. It's having these conversations and making sure that people understand what can be done and how they use the tools.
Where are the jumbo rates right now?
Jumbo rates are all over the place. Those operate very similarly to ARM rates. They tend to be slightly better than the conforming stuff. So I think you're talking mid 6s on those. But we don't do a ton of jumbo in Mass. We do it in Worcester County, your Sterling, Princeton, these areas where there's a low, the conforming loan limit in those areas is still in the 650, 647. We can use the 2023 limits there now, which pushes us into like 770 on those. And you just don't run into a lot of loans over that price range. FHA is still pretty low in the Worcester County areas, in the 400s and stuff. That will go up in 2023. You don't get early access to those things, but like the 1 unit conforming loan limit of Middlesex now is 770. So it's like you don't see a lot of stuff need to go in the jumbo market here. And that, again, these are loan amounts, not purchase prices. So throw your down payment on top of that.
All right.
As you go into Connecticut and Rhode Island and New Hampshire, like you start to see jumbo become more of a thing. But I think if you're talking about focusing in those 6, 7, and 8, even $800,000 price range, you don't need jumbo.
Well, just like you were talking about the Mercedes, does anybody absolutely need a $800,000 house? No. I mean, you're typically, I don't know. In my opinion, if you're buying an $800,000 house, $750,000 house, it's because you want it.
Yeah. There's some amenity or some location.
Yeah, I mean, you could probably find a small house in some of those towns for $500,000 to $600,000, but you want the $750,000. It's again, people that are less likely to be feeling the extreme pinch of all this, right?
Yeah, and it's you know, it's the lower end of the marketplace is the one that is definitely, you know, they got hit at the gas pump, you know, they're getting hit at the grocery store, and you're right, now they're getting hit on the interest rate, but rents are going up as well, you know. Rents are going up at a ridiculous clip, so it's hitting them one way or the other.
Right.
It's almost like in those marketplaces, you almost want to try to get into buy to stop that bleeding, you know, because rents just continue to follow inflation and cost of living adjustments. You can at least stop the bleeding on your mortgage payment. Yeah, insurance is gonna, you know, go up over time. Taxes are gonna go up over time, but not at 6%, not at 7%, you know, on the overall payment.
One of the things I've
You
been
know,
telling agents to do is like, to me, a perfect inflation buster, if you're renting now, is buy a multifamily.
mhm,
Buy a three
yeah,
family. You're going to be in it for less than $1,000 a month. There's no other option that's better right now from an affordability standpoint than buying a multifamily and living in one unit.
yeah,
There just isn't. It's just
yeah,
where else are you going to live for $1,000 a month? I can run an example all day long on multifamilies in Worcester where you could live for less than $1,000 a month.
yep, yep.
But
So I think again, in summary, go back to the database, find the pre-quals that kind of went by the wayside.
yeah,
Start looking at transactions, things that have been on the market, you know, in that mid-range. Maybe even when you're showing a client a house, go to, like, look at these ones before you even go show them the house or go to the open house, call the agent. You know, this has been on the market 30 days. You know, if I pre-sold my client something like a buy down, would your sellers be interested in working out you know, a concession to make a buy down, make this more affordable before you're looking at a price drop? Like pre-sell, get those things in the client in the agent's mind. Oh, I don't even know what that is. You know, I don't even know what a buy down is. Don't be surprised if you get that answer. Most agents aren't totally familiar, especially listing ones, aren't totally familiar with the financing tools today. I don't even know what that is. Oh, call Mike at Mortgage Unity. He'll explain you how it works and how we've closed 2 or 3 deals this way and get your house off the market. And I'm happy to call them and have these combos. That's a great opportunity for me. Even if I don't get that transaction, I can meet a new agent on a warm intro that wants information from me. Please
yeah,
beat down my door for those intros. I'll drop what I'm doing.
100%. Makes sense.
So, and then last thing I would say is, you know, ditch the first time home buyer seminar right now. That's going to be the client that is most wishy-washy. That's going to be the most labor intensive to work on. Focus on fatigued home buyers. You know, focus your marketing efforts on people that want to understand the principles at play and how this is actually a really great time to jump in and buy something.
Right.
When rates are artificially high, the properties values are then inherently artificially low because people qualify for a mortgage payment, not a purchase price.
It's true.
Who's on the biggest cash spending spree right now? Warren Buffett. Okay. Because he's able to buy things in cash that people are checking the brakes on because they need to finance or debt service. And so he's buying everything on sale right now. Yeah. Everything is inherently undervalued when rates are high. So just as during COVID, everything was inherently overvalued when rates were low. So it's a really good time to buy. And if you watch what the people that know financial principles are doing, you know, Warren Buffett, you know, Bill Gates is on a spending spree. Like, just do a little back end research of where the cash is going, and the big buyers are buying right now because they're able to buy things on sale. So fatigued home buyers, someone that wants to understand what's going on, wants to understand why this is a great time to buy. It's that's where I'm
just finding the pain that's in their lives. You know, hate your neighbor. You know, tired of uncontrollable increases in rent prices. You know, it's just, you know, we used to be able to just market the excitement of a rate. You know, like that's I mean, nobody loved the home prices. People were buying based on the fact that we could sell, you know, look how low the rates still are, or look how low the rates are. Like, And it
Yep.
was driving prices up and up and up, and now it's like, we can't use that anymore. So it's like a lot of agents are just like, I don't know what to do. You have to get more creative in how you market. You have to get more creative in how you uncover their pain and try to determine if their pain is worse than their fear of inflation or affordability or anything like that. And, get them to make a personal decision. Maybe it is a wait and see. You
Yeah.
know, any conversation you have now as a real estate agent, it's okay if they're just like, if you've had a conversation with them and they may talk to you and it's just, it makes sense for you to work on your credit a little bit more and be ready to buy in mid 2023. I mean, we're all right now working on now business and future business.
Yeah.
The relationships we build now will eventually turn into business, even if that person's just gonna sit on the sidelines for a while because they've got a decent rent for the next year locked in. Who knows?
Yep.
You know what I mean?
And don't don't sell yourself out of the conversation. This is something that Meg and I had to really kind of wrap our heads around. Kim as well. Kim's my business partner in Bridgewater. I don't know if you've all met her,
Yeah.
but we were getting tepid at telling these clients what these payments were going to be. Okay. Like we were kind of pre-selling against in our heads. Oh man, I quoted this person a payment back July of last year and it was $2,700. That payment's $4,000 now for what they want to buy. And we're like, oh dude, I don't want to have this conversation, and that's not all interest rates. Now the home's $70,000 more expensive, right? And the interest rates are up. So we go back to them and like, yeah, that $2,700 payment you're looking at, that's $3,900 now. Okay, no problem. I'm gonna place the offer for X. Like you would be shocked at how people are absorbing this. You hear about everybody freaking out because of what the news says and what people say on Facebook, but a majority of the conversations we're having when we run these numbers by the clients, they are not losing their shit about it. They're kind of like, all right, cool.
Right.
It's in line with what I was going to be looking at for new rentals.
Does it make sense then just to be kind of as real estate agents say, what are your thoughts on where you'd like to be on a monthly payment before anything else? Before talking home prices, rates, anything like.
I think it's good to get that number, but I think to have the conversation, you want someone, someone like myself or a mortgage professional to be able to give them context to the number that they're looking at. I have one more I'm working on right now.
I agree with that. I think right now more than any other time, it's like, before we get too far, let's pull in a mortgage lender that you can talk to really have a deep conversation about that end of it. I think agents got used to like, we could just bring in a lender at the last minute. Let's just bring in a lender at the last minute right before you're ready to make offers. And like, hey, Mike, we need a pre-approval in 24 hours because we're making offers. It's not that we're in a totally switched market from that perspective. It's like, I'm like, let's figure out if it's right for you to buy now, or maybe it's not, but let's pull in a mortgage lender to talk to you a little deeper about this. Because most agents are just not going to be equipped at like running a mortgage calculator, figuring all that out, figuring out the options, talking about the crap that's in their head, the baggage that they've built into their head, why now may not be a good time to buy. It's just a conversation that we can't successfully have, I don't think, without having someone like yourself involved.
Know exactly what to say, Tracy. Use the term mortgage planner. Okay. Don't use mortgage broker. Don't use mortgage lender. Use the term mortgage planner.
I like it.
It immediately frames their mind around financial planning.
I'm doing a reel about that today. That's a perfect analogy.
Yep.
Like,
so being mindful about what you say and how you present it. Anybody that again watches this, go to all the know exactly what to say stuff. It's exactly the type of thing that you need to pay attention to now. The news sold our product for us for the last 2 years. Okay. Now they're inadvertently selling against it. And so we need to bridge that gap, rent first buy analysis, 2-1 buy downs, there's a lot of crappy mortgage professionals that got in the business the last 2 years because it was order taking. They can run around and they can quote 2-1 buy downs and tell you they have the program, but then effectively communicating that to your client is
Right.
a whole different ballgame. And a lot of them present it as points. It is not points. A 2-1 buy down is money that is in the pocket of the consumer. If they refinance that mortgage, it's sitting in escrow. If they don't use all of the 2-1 buy down, it pays down the principal on their loan. It's not money that's blown off into the ether.
All
Like,
right.
it is there to pay that interest and clock it through escrow for 2 years.
A lot of
If
people.
you refinance it 6 months from now, you get that cash back.
Right.
So, and eventually as rates come down, that extra escrow, that could be money used for a point rate buy down or something to get in a nice long-term fixed rate when you're closing it out. It's not points. All right. And that's the number one thing that I think I watch a lot of these, 7-digit NMLS number people, anybody with a 2 in front of it, 7 digits with a 2 in front of it. Make sure you're getting someone else explaining the 2-1 buy down, because they don't know this. I haven't used 2-1 buy downs since probably 2010, 2011.
Yeah.
I
don't know if I've
builder
done more than
space.
a couple in my entire career.
Yeah.
And at
So,
most, I mean, maybe it was only one.
yeah. It's been a while, and there again, it's a tool. It's a really effective one. It's one that we're saving a lot of deals with, and we're making sellers a lot of money with, and effectively planning for the buyers. But it takes some explaining, and it takes some coaching on how that works. And you want to make sure that you're using a mortgage planner and not just someone that's taking orders. And I got one from Rocket Mortgage, $8,500 in points with a $12,000 2-1 buy down on it. It's like, what are we doing here? The goal of this thing is to get out of this in 2 years. Like, why are we dumping these points that are just going to be blown away in 16 to 18 months? Like, you've got to coach your clients on a more strategic basis right now.
Right.
And that's what we're here to do for you.
Let's create a strategic plan for you, whatever that looks like. Let's help you create that plan.
Yeah, social media content's great. I can come on, I can take you guys to happy hours all I want. It's not going to help you sell a house right now. So get me a conversation with a seller that
Right.
might need some coaching to cough up a buy down to make a deal work. Get me involved with maybe one that's
They're
close.
using it out in Vegas, and instead of doing a $15,000 price reduction, they're doing a 3-2-1 buy down out there, and it's because the houses are still appraising. So instead of dropping the price, they're just putting the money into the buy downs, and they're selling properties faster that way.
Why do builders give $6,000, $8,000, $10,000 towards closing costs on every single home that they build? It's because it helps them command the highest price possible. It's
Right.
money.
They don't want the price effective. They'd rather give money away than have that sale.
Exactly. And you can't do a price reduction, right? And then pump the price back up. You can offer 15 grand towards a buy down and then take it out of the MLS comments later if you want to.
All right. Half the agents don't put this concession in the MLS when they close it. Trust me, they don't.
Yeah.
Yeah, they just don't. They're like, okay, sale price gone, boom.
Yeah.
Because it takes looking it up to remember what this closing cost credit was, so they don't put it in there.
So that's my 2 cents. I got a jet because I got to.
Yeah, I appreciate it. This went a little longer than I expected, but it was great. I'm going to share it later on to everybody that didn't make it. I've got the recording, so appreciate your time, Mike. It was great. Some good stuff that came out of this.
You got it. Take care.
Later, man.